The silver market has become a focal point for investors and analysts alike, with its volatility surging beyond an astonishing 100% in recent times. This dramatic price action, often described as gold on steroids due to its heightened sensitivity, is prompting a critical reassessment of the metal's valuation and future trajectory. The question on everyone's mind is not just how high it can go, but where, if anywhere, is the sustainable bottom amidst such unprecedented swings? Several confluent factors are fueling this extreme volatility. A primary driver is the persistent physical supply deficit, with the market experiencing 5 consecutive years of inventory drawdowns. This scarcity is compounded by accelerating industrial demand, particularly from burgeoning sectors like solar panels, electric vehicles, and AI-related applications. Silver's unique electrical conductivity makes it indispensable in these high-growth industries, anchoring a significant portion of its global demand, nearly 50%. Adding to the complexity is the widening chasm between the paper futures markets and the physical supply availability. While cash-settled futures contracts can experience rapid declines due to margin increases and leverage unwinds, the physical metal remains scarce, leading to buyers paying rising premiums over spot prices. This disconnect means that selling pressure in paper markets often reflects leveraged traders exiting positions they never intended to settle with actual metal, while industrial users and physical buyers continue to compete for a limited supply. Expert predictions for silver's future price vary wildly, reflecting the current market uncertainty. Some analysts, citing sustained industrial demand and supply deficits without dramatic speculation, foresee prices averaging around 45 to 50 per ounce in 2026, with year-end targets in the 47 to 51 range. Others, however, are far more bullish. Bank of America, for instance, has suggested silver could peak around 56 per ounce, with some aggressive forecasts from commentators like financial author Robert Kiyosaki predicting silver could reach $200 per ounce by 2026, driven by industrial demand and its safe haven appeal. Even more speculative targets from CoinCodex models project silver hitting $532.03 by the end of 2026, representing a monumental increase. However, not all outlooks are universally optimistic. Some financial institutions, such as J.P. Morgan, have warned that silver could crash back to $50 per ounce by 2026, viewing the recent rally as a speculative, meme-driven mania ripe for a violent unwind. These cautionary tales often draw parallels to historical market bubbles, emphasizing silver's inherent higher volatility compared to gold and its propensity for sharp corrections. Beyond the interplay of supply and demand, macroeconomic factors significantly influence silver prices. A strong U.S. dollar typically lowers silver prices, as it makes the commodity more expensive for foreign buyers, while a weaker dollar has the inverse effect. Inflation and low interest rates tend to increase demand for silver as investors seek a hedge against economic uncertainty and currency devaluation. Geopolitical events also play a crucial role, often pushing investors towards safer assets like silver during periods of instability or conflict. The structural characteristics of the silver market, including its relatively small investable market size and its dual nature as both an industrial commodity and a monetary asset, are fundamental to its persistent volatility. Approximately 70% of global silver production is a byproduct of base metal mining, leading to supply inelasticity that prevents rapid adjustments to meet demand fluctuations. This means that silver supply often responds more to the dynamics of copper, zinc, and lead markets rather than direct silver price signals.